I read an interesting investor survey that was completed towards the end of 2018. Had some interesting numbers and statistics about the self-storage industry. Let me give you my takeaway on it. My name's Mark Helm. I'm the author of Creating Wealth Through Self-Storage, and I'm the creator of the Self-Storage Quick Start Academy. And what I do is I support small investors who want to get in the self-storage business or who want to grow their self-storage business, strategically do so in a way that creates true wealth and a fulfilling career. I have all kinds of training and support for the small investor at creatingwealththroughselfstorage.com under the blog and training section and the quickstartacademy.com. But I recently read an investor survey that was completed at the end of 2018, and let me share with you some of the statistics that they gave in that survey. Now, I don't relate to these surveys and these trends as exact. I've read them all throughout my real estate career from these larger companies, and what I've noticed is three large companies can be talking about and measuring the same statistic over the same time period, and each of them will come up with different numbers. But what I do find interesting is the trend that they point to. There's a trend that all of them are pointing in a direction in, even though the numbers may vary. Now keep in mind, this was a survey of investors in self-storage. So the first forecast was, what is your forecast for rent growth in the self-storage industry? And there was a lot of complaining and upset about the rental growth of self-storage. They said overall we see the rental growth in self-storage only being 3.5% for the next year, 2019. Now I don't know what you do, but when I'm analyzing a project, I've always tried to keep my rental growth averaging around 3% a year. So the survey went on to say that compared to other sectors of the real estate industry, self-storage is very robust. Now, you won't read that in the papers anywhere or in any of the periodicals, and if it's there, it's usually buried at the bottom. Now, compared to the past few years' rental growth, yes, 3.5% is down. The next stat that I found very interesting, and it's really not a statistic I look at that closely, and I may start paying more attention to it, is the average trade area. And they said that the average trade area is 3.18 miles from the facility. Now, we track our facilities. I know that in our portfolio, 86% of our customers live within 4 to 5 miles or less. I don't know the average. I've never really tracked that, and we might start tracking it more. When we get a feasibility report, they'll talk about what the trade area is, and we'll start measuring that, but I don't know if that's gone up or down, but it's right what I would have guessed. I would have guessed between 3 and 4 miles is the average trade area. Obviously, when you're in denser populated areas, like a major Tier 1 city, it's going to be closer. If you're in a rural area or a smaller town, your trade area is going to be larger. The next statistic that was talked about was the average absorption time. They said that the average absorption time has gone up, which is not surprising given all the new product that's been constructed. But what's interesting is they said the average absorption time went up a couple months to 30 months. Now, they didn't say what is the average size of the facility. I found that how long the absorption takes is usually a function of the size of your facilities. In the old days, back in the mid-90s, when I was working with REITs, the REITs that I work with used a figure of 5% a month. They projected in their absorption schedule that 5% of their square footage would lease up each month, would go into service each month. Now, when I started using that metric early on in my career, I was not hitting the numbers very well. So we transferred over to net square feet per month in lease up. Now, we all know that in some parts of the year, the net square footage is much higher in absorption than the other, but we try to come up with an average. So that 30 months lease up, somewhat meaningless to us because I don't know the size of the facility, so it's hard to transfer over. But yes, our experience is 3 to 4 years, and if we're running into an overbuilt market, it can be 4 to 5 years on new construction, 50,000 square feet or more. Next interesting statistic was the optimism index. I've never put a lot of stock in the optimism index. I think it has a lot more relevance when you're trading stocks on a daily basis. But the optimism index actually went up. It went up to 7.1 out of a scale of 1 to 10. I found that rather odd. So I did a little more digging, and I found out that in the height 2015 through 2016, the optimism index in the self-storage industry got all the way up to a whopping 8.1%. And the lowest it's been was last year, 2017, from when this was written, at 6.9%. Now, I don't know about you, but if I'm only having 80% optimism in self-storage in 2015 and 16, where all you had to do was turn the lights on and you were making money, I don't know that I would invest a lot of money in the self-storage space. So I'm not sure how that's really relevant to what we do as small investors, but I found it very odd that 80%, 81% optimism was as high as it's gotten in the self-storage space by investors. I think that says more about investors in the human psyche than it says about self-storage. Interestingly enough, the next stat is cap rates. Investors think that the average cap rate's going to go up 0.25%. Now that was for Class A type institutional grade self-storage facilities in larger markets. I think that yes, in a Houston or an Atlanta, in an institutional grade facility, you're going to see cap rates maybe go up. I think in the B and C properties, and once you get out into the smaller towns of the U.S., I think you're going to see the cap rates going up further than that. Because as the REITs slow down on their acquisition, which they are doing, what's going to happen is properties priced at a C property priced at a 6 cap rate or a 6.25 cap rate is going to sit, and the seller's going to have two choices. They can either lower the price or they can take it off the market. So I think in the properties that REITs aren't really going for anyway, you're going to see a much higher increase in the cap rate. And as we all know, the higher the cap rate, the lower the price. If you're not sure what a cap rate is, you can click in the comments. I'm linking to a video we did on cap rates, and that can help you understand how we use cap rates to value self-storage. So I share all this with you, not to tell you this is exactly what's going on, but to point to some trends that are happening. At the end of the day, market conditions have changed over the past couple of years. More properties come in the market, more players have hit the market. We're going to be spending more money on marketing than we have in the past. And we're also probably going to be spending more money on property taxes than we have in the past. Property taxes have caught the eye of the assessors all across the country, and our operating expenses probably will go up for the next few years. Now, we're combating that increase in operating expenses by working on keeping our personnel costs the same or lower by using technology to offset some personnel costs. We're also using new and different pricing strategies that will help us keep our income as high as possible. And we've talked about those with value-add pricing strategies. So net operating incomes may be slightly down over the next few years, but keep in mind, all types of investment properties cycle and go through economic cycles. We are approaching oversupply. In some markets, we are oversupplied. But if you keep your eye on the ball, know your numbers, put more square feet in submarkets that have unmet demand, and know that before you build or add more square footage, and you work hard on keeping your expenses in line and keeping your income going up as much as possible, and using some new revenue models, experimenting with it, we should be able to keep the NOIs pretty high. They may not be quite as high as we had in our projections over the next couple years, but remember, this is a long play for most of us. Unless you're flipping self-storage, this is a longer play. So when we do a 10-year performa or a 5-year performa, these are averages that we're going for. And what happens in year 1, year 2, year 3, yes, is important, but remember, it's the average over the long haul and ownership of that asset that makes the difference. If you can keep your expense growth under your income growth year after year, that gap between income growth and expense growth compounds over time. And it's that compounding of that increase in income over operating expenses that really creates the value for the self-storage investor. Keep your eye on that ball and that game, and you'll do just fine over the next couple years. So thank you very much. My name's Mark Helm. I'm the author of Creating Wealth Through Self-Storage, and I'm the creator of the Storage World Analyzer. That's the financial analysis software that we use to create the financial models for the upcoming years of our ownership. If you're using Excel, great. We use Excel, but we also use the analyzer. We find that it works very well specifically for self-storage. It's the only cloud-based financial analysis software I'm aware of that's specifically designed for the self-storage industry. If you're not using it, explore it. Consider using it. I think it will make a big difference. You can go to storageworldanalyzer.com, or you can go to creatingwealththroughselfstorage.com and click the Storage World Analyzer tab. So thank you very much. I look forward to being with you again next week, and I'll see you then.